Welcome back to Financial Insights. We must discuss something. Over recent weeks, we have fixated on silver. We have observed the vaults emptying, the mint shuttering, and prices shooting upward. And justly so. The silver squeeze remains the most thrilling narrative in finance at this moment. Yet while monitoring the precious metals sector, something fractured in the bond sector. Something so enormous, so fundamental, and so frightening that it renders the silver squeeze a rounding error. If silver represents the canary in the coal mine, the Japanese bond sector is the atomic weapon resting at the base of the mine shaft. And the clock just reached zero. We're examining market signals that indicate a major structural transformation. The yields on Japanese government bonds, JGBs, are climbing to heights we haven't witnessed in decades. The 10-year yield has reached 2.34%. The 20-year yield stands at 3.47%. The 30-year yield sits at 3.90%. And the 40-year yield has breached the 4% threshold to reach 4.23%. Now, if you reside in the United States, you might observe those figures and ask, so what? US rates exceed that. But you must grasp the background. For 3 decades, Japan has existed as the realm of zero interest rates. For 3 decades, the Bank of Japan has anchored these rates to zero to sustain their zombie economy breathing. In Japan, a 10-year yield of 2.34% isn't merely high. It represents an economic cardiac arrest. It signifies the expense of maintaining their enormous national debt has tripled or quadrupled overnight. Why does this concern you? Why should a person in Texas or a household in London worry about the yield on a Japanese bond? Because Japan serves as the global lender. They are the wealthy relative of the world economy. For decades, Japanese investors have gathered their savings, which generated 0% at home and dispatched them overseas. They purchased U.S. treasuries. They acquired European bonds. They bought U.S. tech stocks. Japan possesses over $1 trillion of United States government debt. They possess hundreds of billions of dollars in U.S. equities. But now the situation has reversed. With yields at home climbing to 4%, the Japanese investor no longer requires sending their money abroad to obtain a return. The market is being drawn toward these 4% yields in Tokyo in their own currency, without concern about exchange rates. This generates a massive sucking sound. It is the noise of trillions of dollars of liquidity being extracted from the global markets and flooding back into Japan. We term this the Great Repatriation, and it is the catalyst for a global margin call. Consider the global financial system as a massive leverage trade. For years, hedge funds and banks have borrowed money in yen because it was free and utilized that money to purchase Nvidia, to purchase Bitcoin, to purchase real estate. This is the famous carry trade. But now the yen is becoming costly. The expense of borrowing has rocketed. So what must the traders do? They must repay the loan. And to repay the loan, they must liquidate the asset. They must liquidate the Nvidia. They must liquidate the Bitcoin. They must liquidate the real estate. The surge in Japanese yields is the needle that bursts the everything bubble. We are already witnessing the tremors. The volatility in the U.S. stock market this week is not accidental. It is the initial stages of this unwind. The data we are examining reveals a distinct pattern. If the global system were operating normally, we simply wouldn't witness these yields. Trust me, conditions are not normal. We are observing a sovereign debt crisis in the world's third largest economy. Japan has a debt to GDP ratio of roughly 260%. That is the highest in the developed world. When you possess that much debt, you cannot afford elevated interest rates. Every 1% increase in rates devours a substantial chunk of the national budget. At 4%, the interest payments alone could devour the entire tax revenue of the Japanese government. This signifies the Japanese government is confronting a fiscal crisis where servicing their debt could potentially surpass their tax revenue. So why are they permitting rates to rise? Because they have no alternative. Their currency, the yen, was imploding. To rescue the currency, They had to cease printing money to purchase bonds. When they halted buying bonds, the price plummeted and the yield soared. They had to select between rescuing the bond market or rescuing the currency. They selected the currency, and in doing so, they just detonated the global cost of capital. This is a systemic event. When Japan sneezes, the world catches a cold. But Japan isn't sneezing. Japan is having a seizure. The immediate threat to your portfolio is not the Japanese economy itself. It is what the Japanese institutions are about to execute to your economy. There is mounting speculation among market analysts that we could witness major Japanese pension funds and insurers begin to reduce their U.S. holdings in the very near future. They are holding approximately $500 billion of U.S. stocks. Why are they liquidating? Because they require the cash to cover their losses at home. When the value of their Japanese bond portfolio collapses, remember when yields rise, bond prices decline, they have a gap in their balance sheet. To fill that gap, they must liquidate their profitable positions. And their winning tickets are U.S. tech stocks. This is why we caution about a slow grind downwards. The data indicates they won't dump it all at once. That would be too catastrophic. Instead, they will liquidate slowly, methodically, day after day for the next 12 to 24 months. This generates a permanent headwind for the stock market. Every time the S&P 500 attempts to rally, a Japanese pension fund will step in and press the sell button. It is like attempting to swim upstream against a relentless current. This is why the analyst in the data cautions the world is entering a rate environment no one alive has traded before. We have never witnessed a world where Japan is a net seller of global assets. For our entire investing lives, they have been a net buyer. The flow of the river has reversed, and this reversal impacts everything. It impacts mortgage rates in the U.S. It impacts the price of gold. It impacts the stability of the euro. But the biggest victim will be the U.S. Treasury market. Japan is the largest foreign holder of U.S. debt. If they cease buying, or worse, if they begin selling, who replaces them? Who purchases the trillions of dollars of debt that the U.S. government issues every year? The Fed? We understand that leads to inflation. China? They are liquidating too. Saudi Arabia? They are purchasing gold. The buyer of last resort is gone. This is why U.S. yields are likely to surge alongside Japanese yields. And when U.S. yields surge, the economy fractures. Housing fractures. Auto loans fracture. The banks fracture. We are watching the dominoes tumble in slow motion. The first domino is the Japanese yen. The second domino is the Japanese bond market. The third domino is the U.S. stock market. And the final domino is the U.S. dollar itself. Because when the dust settles and the selling ceases, the only way the system survives is if the Federal Reserve prints enough money to purchase everything Japan is selling. They will have to monetize the entire debt stack. This brings us back to silver. Why is silver hitting $94? Why is gold hitting $4,600? Because the smart money observes what is occurring in Japan. They understand that the only solution to a sovereign debt crisis is currency debasement. They're not purchasing silver just because they appreciate solar panels. They are purchasing silver because they are fleeing the bond market. They are running away from the widowmaker trade. Japan is the canary. The explosion has occurred. The shockwave is traveling across the ocean. In the next part of this deep dive, we are going to examine the repatriation event. We are going to analyze the specific assets that are at risk. We will examine the $500 billion figure in more detail. Which stocks do they possess? Which sectors will be struck the hardest? And we are going to clarify why this selling pressure is unlike anything we have witnessed before. Because it is involuntary. They aren't selling because they desire to sell. They are selling because they must sell. It is a forced liquidation. It is a margin call on a continental scale. And when a margin call hits, the market doesn't care about your valuation. The market doesn't care about your earnings multiple. The market doesn't care about your growth story. The market only cares about one thing: cash. The institutions need cash, and they need it immediately. So they liquidate what they can liquidate. And what can they liquidate? They can liquidate the most liquid, most transparent, most accessible market on the planet, which is the US stock market. This is the danger of being the global reserve currency. You become the ATM machine for every crisis. When Mexico collapsed in the 1990s, they sold US stocks. When Russia defaulted in 1998, they sold US stocks. When the Asian financial crisis struck, they sold US stocks. And now, when Japan implodes, they will sell US stocks. This is the price of being the most liquid market in the world. You become the exit door. You become the sacrifice. So let's talk specifics. Which stocks are in the crosshairs? The research shows that Japanese institutions are heavily concentrated in the big tech names. They own Apple. They own Microsoft. They own Alphabet. They own Amazon. They own Nvidia. They own Tesla. These are the Magnificent Seven. These are the stocks that have driven the market higher for the last 3 years. And they are the stocks that Japanese pension funds are sitting on with massive unrealized gains. In a liquidation scenario, you sell your winners. You do not sell your losers because your losers have no liquidity. You sell the stocks that still have a bid. You sell the names that the market still wants. This creates a paradox. The strongest stocks in the market become the most vulnerable to Japanese selling pressure. It's like a bank run, but in reverse. Instead of depositors pulling their money out, it's the owners of the bank dumping their shares. The impact is the same. The stock goes down. And when the biggest tech names start going down, the index goes down. And when the index goes down, the passive ETFs start bleeding. And when the ETFs start bleeding, the retail investors panic. And when retail panics, the algorithms kick in. This is how a slow grind turns into a flash crash. The Japanese selling is the spark, the algorithmic trading is the gasoline, and the passive indexing is the bomb. This is a structural vulnerability in the modern market that almost no one is talking about. Because for years, the flow was going in the opposite direction. For years, the Japanese were buying. For years, they were propping up the market. For years, they were the invisible hand providing the bid. But now the hand is pulling back, and the market is about to discover how much it relied on that bid. This is the hidden truth of the bull market. A large portion of the gains over the last decade were funded by Japanese capital flowing into US assets. When that flow reverses, the gains reverse too. It's Newton's third law applied to finance. For every action, there is an equal and opposite reaction. The action was 30 years of Japanese capital inflows. The reaction is 12 to 24 months of Japanese capital outflows. And we are at the beginning of the reaction. So where does that leave you as an investor? If you own the S&P 500, you are sitting in the path of a liquidation tsunami. If you own the Nasdaq, you are sitting at ground zero. If you own individual tech stocks, you are standing in the blast radius. You have three options. Option 1, you stay in the market and hope that the selling pressure is absorbed. This is the hope trade. It's betting that the Fed will step in and print enough money to offset the Japanese outflows. It's possible, but it comes with a cost. That cost is inflation. If the Fed prints $500 billion to buy what Japan is selling, the dollar weakens and your purchasing power declines. You might keep the nominal value of your portfolio, but the real value erodes. This is financial repression. Option 2, you rotate into defensive sectors. You move out of tech and into utilities, consumer staples, healthcare. These are the sectors that traditionally hold up better in a downturn. But here's the problem. If Japan is selling across the board, no sector is truly safe. The liquidation is indiscriminate. When you need cash, you sell everything. So the defensive trade might cushion the blow, but it won't eliminate the risk. Option 3, You exit paper assets entirely and move into hard assets. This is the most radical option, but it's also the most logical. If the problem is a sovereign debt crisis, if the problem is too much leverage, if the problem is currency debasement, then the solution is to own assets that cannot be printed. You own gold, you own silver, you own commodities, you own real estate, you own anything that has intrinsic value independent of the financial system. This is the hard money trade. And it's not just about preserving wealth. It's about positioning for the next phase of the economic cycle. Because when the Japan crisis reaches its peak, when the Fed is forced to print, when the dollar is being debased, the assets that will perform the best are the assets that benefit from inflation. Gold will rally, silver will explode, oil will surge, and the stock market will stagnate. We saw this in the 1970s. We are seeing it again now. The data is screaming at us. But most investors are not listening. They are anchored to the paradigm of the last 15 years. They believe that stocks always go up. They believe that tech is invincible. They believe that the Fed has their back. But the Japanese bond market is telling a different story. It is telling us that the era of free money is over. It is telling us that the debt must be serviced. It is telling us that interest rates matter. And when interest rates matter, the valuation of growth stocks collapses. Because growth stocks are valued based on future cash flows, discounted back to the present. When discount rates go up, the present value goes down. This is Finance 101. But in a world of zero rates, nobody cared. In a world of zero rates, you could justify any valuation. You could say that Tesla is worth $1 trillion because the future is electric. You could say that Nvidia is worth $3 trillion because AI is the future. You could say anything and the market would believe it because the cost of capital was zero. But now the cost of capital is 4% in Japan and rising in the US. The discount rate is going up. The valuations are coming down. This is the mathematical reality that the market is about to confront. And it's not just tech stocks. It's everything. Corporate bonds, junk bonds, real estate, private equity. Every asset that was priced for a zero-rate world is about to be repriced for a 4% rate world. This is the great repricing, and it's happening right now. You can see it in the credit spreads widening. You can see it in the commercial real estate defaults. You can see it in the venture capital fundraising collapsing. The cracks are everywhere. The only question is how fast the crack spreads. And Japan is the accelerant. Because Japan is not just raising rates. Japan is forcing the entire world to raise rates. When Japan stops buying U.S. treasuries, the U.S. has to offer higher yields to attract other buyers. When the U.S. offers higher yields, Europe has to offer higher yields. When Europe offers higher yields, emerging markets have to offer higher yields. It's a global repricing of risk. And the higher the yields go, the more painful the adjustment becomes. This is why the analyst warned of a maximum de-risking event. This is why the data is flashing red. This is why we are sounding the alarm. We are not fear-mongering. We are reading the market, and the market is telling us to get out of the way. So let's talk about the timeline. How fast does this happen? According to the research, the liquidation will be slow and methodical. They estimate 12 to 24 months. This is not a one-day crash. This is a grinding, relentless, day-by-day selling pressure that wears down the market over time. Think of it like water dripping on a stone. One drop doesn't do anything, but 1,000,000 drops over 2 years will carve a hole. That's what the Japanese selling pressure will do to the stock market. It will carve a hole. Every rally will be sold into. Every dip will be sold into. There will be no sustained recovery because the selling never stops. And the worst part is that most investors won't even realize it's happening. They will see the market down 5% and think it's a buying opportunity. They will see it down 10% and still think it's a correction. They will see it down 15% and start to worry. But by the time they realize what's happening, the exit door will be crowded. This is the nature of a slow grind. It lulls you to sleep. It makes you think you have time, but you don't, because the institutions are already moving. The smart money is already repositioning. The hedge funds are already cutting risk. And by the time the retail investor realizes the game has changed, it will be too late. So the question is not whether the Japan event will impact the markets. The question is whether you will act before or after the crowd. If you act before, you preserve your wealth. If you act after, you become the exit liquidity for the institutions. The choice is yours, but the clock is ticking. Now, let's address the elephant in the room. Why aren't more people talking about this? Why isn't this on the front page of every financial news outlet? The answer is simple. Because it challenges the narrative. The narrative is that the economy is strong, that the stock market is resilient, that the Fed has everything under control. But the Japan event exposes the lie. It exposes the fragility of the system. It exposes the dependency on foreign capital. It exposes the fact that the US economy is a house of cards built on Japanese money. And nobody wants to admit that. The media doesn't want to admit it because it would cause panic. The government doesn't want to admit it because it would undermine confidence. The institutions don't want to admit it because they are still selling their inventory to retail. So they stay quiet. They downplay the risk. They say that Japan is a local issue, that it won't spread, that the US is insulated. But it's all a lie. The truth is that the global financial system is one giant interconnected web. When one thread breaks, the whole web shakes. And Japan is not just any thread. Japan is one of the main support beams. When Japan breaks, the whole structure collapses. This is not hyperbole. This is the reality that the data is showing us. And if you are waiting for the mainstream media to tell you when to act, you will be too late. Because by the time they report it, the damage will already be done. So you have to think for yourself. You have to look at the data. You have to connect the dots. And when you do, the picture is clear. The Japanese bond market is in crisis. The Japanese institutions are preparing to liquidate. The US stock market is in the crosshairs. And the only safe harbor is hard assets. Now let's talk about the second-order effects. What happens after the initial liquidation? What happens when Japan has sold its $500 billion of US assets and repatriated the cash? The answer is that Japan will need to redeploy that capital domestically. They will need to rebuild their bond portfolio. They will need to fund their budget deficit. They will need to service their debt. And to do that, they will need to buy Japanese government bonds. But here's the problem. The Japanese government is issuing bonds at 4% yields. And at 4% yields, the interest payments consume the entire budget. This creates a death spiral. The government issues more debt to pay the interest on the old debt. The new debt comes with higher interest rates. The higher interest rates require even more debt. And the cycle continues until the system collapses. This is the definition of a sovereign debt crisis. And the only way out is to inflate the debt away. This means the Bank of Japan will eventually have to start printing money again. They will have to monetize the debt. They will have to buy the bonds that the market won't buy. And when they do, the yen will collapse. And when the yen collapses, the carry trade will unwind even further. And when the carry trade unwinds, the global liquidation accelerates. This is the feedback loop that the market is not pricing in. This is the doom loop. And we are already in the early stages of it. The yen is weakening. The yields are rising. The selling is beginning. And the loop is starting to spin. Once it gains momentum, it will be impossible to stop. This is why the timing matters. This is why you need to act now. Because once the doom loop is in full motion, the market will gap down. There will be no gradual decline. There will be a sudden, violent repricing. And if you are still holding paper assets when that happens, you will be wiped out. So the message is clear. The Japan event is not a theory. It is not speculation. It is happening right now. The evidence is in the data. The yields are spiking. The institutions are preparing. The selling is about to begin. And the only question is whether you will be ready. Now, let's discuss the broader implications for the global economy. If Japan is forced to liquidate its foreign assets, it will create a vacuum in the global capital markets. For decades, Japan has been one of the largest sources of capital for the world. They funded the US deficit. They funded European infrastructure. They funded emerging market development. But now that capital is going home. And when it goes home, who fills the gap? The answer is nobody. There is no other country with the savings rate and the capital surplus to replace Japan. China is already selling. Europe is broke. The Middle East is diversifying into gold. The buyer of last resort is gone. This means that the cost of capital is going to rise globally. Interest rates will go up not because of inflation, but because of a shortage of capital. And when interest rates go up, the global economy slows down. We are already seeing signs of this. The IMF has downgraded global growth forecasts. The World Bank is warning of a synchronized slowdown. The credit markets are freezing up, and the recession indicators are flashing red. But the mainstream narrative is still talking about a soft landing. They are still talking about resilience. They are still in denial. And by the time they acknowledge the reality, it will be too late to act. This is the information asymmetry that creates wealth. The people who see the crisis coming and position accordingly will survive. The people who believe the narrative and stay in paper assets will be destroyed. The choice is binary, and the clock is running out. So let's get practical. What does the portfolio of the future look like? If we are entering a world of rising rates, sovereign debt crises, and currency debasement, what should you own? The answer is simple. You own hard assets. You own things that cannot be printed, that cannot be debased, that cannot default. You own gold. You own silver. You own commodities. You own energy. You own food. You own water. You own land. These are the assets that have intrinsic value. These are the assets that will preserve purchasing power when the paper system collapses. And make no mistake, the paper system is collapsing. The bonds are collapsing. The stocks are collapsing. The currencies are collapsing. The only question is how fast. And Japan is the catalyst that accelerates the collapse. Because when Japan sells, it forces everyone else to sell. And when everyone sells, the system breaks. This is the endgame, and we are watching it unfold in real time. Now, within the category of hard assets, there is a hierarchy. At the top sits gold. Gold is the ultimate store of value. It has been money for 5,000 years. It has no counterparty risk. It cannot be printed. It cannot be debased. It is the anchor of wealth in a world of chaos. And the price of gold is already reflecting the crisis. Gold is hitting all-time highs. And it will continue to rise as the Japan event unfolds.